The term spread really relates to the difference between the buy and the sell price and the difference between the two. So what is spread betting? Spread betting is effectively an individual, such as yourself, making a bet that an instrument such as an FX pair, an equity index, a commodity goes in a direction that you intend it to go or you believe it will go. For example, if you believe that the dollar yen is going to go up, you would be buying that and you choose your stake or your pound per point movement. And then if that goes up, then effectively each pip or each point that goes up, you'll be making that stake. One of the key advantages of spread betting, apart from it being capital gains tax free, is the idea that you're placing a small amount of money to get that larger notional exposure. This is what we call leverage, where you're placing a margin or a deposit down on that initial position. This allows you to allow your capital to work harder for those positions. And for markets where generally previously you'd have very high barriers to entry, it means that anyone can really get involved in those positions. Now with spread betting, you're dealing in pounds per point. You have the control to deal in the position size of your choice, and that will mean, do I want to do in £1 per point or a portion of £1 per point or even £10 per point or £50 per point. You get the choice of how big your position size is relative to the size of your account. And of course, position sizing is one of the key factors that traders have to consider when they're above pretty much everything else. But you have the flexibility of trading pound per point. So for example, if we've got cable or pound against the US dollar trading at 130.00, at 130.02, and we believe that that's going up, of course we'd be buying off the offer price of 130.002, and I decide that I want to buy £1 a point. Now over a period of time we can see that the bid price has gone up to 130.04. Effectively, I can sell out at that level there for a 2-point gain. Effectively, in that situation, I times the amount of pips that I've made or points I've made times by my initial stake, and that's my profit in the market. Of course, if the position goes against me and cable or sterling against the US dollar falls, then I'm going to lose the amount of points times by my initial stake in that situation. When you enter a trade, there is no fixed expiry. You can be in the trade for as long as you want or as short as you want. That really depends on if you're making enough money or where your risk profile is coming into play, or whether you want to take that loss off the table earlier than you expected to. There is no set definition as to how long you want to be in the trade. That is completely up to you. What you need to remember is that as part of the cost structure is if you hold a position past rollover, you will be charged a funding fee for that position, just like you would be in CFDs. So really when you're talking about the duration of a position and how long you're looking to hold it, there is no fixed expiry onto that. You can hold that for weeks, months, years if you want, or you could be holding it for seconds. There is no set expiry.